Nobody ever gets rich when the interest rates are high because people can't borrow money.
Is that what you meant? The stock market going down was the disruption? What other disruption were you alluding to?
You can't really watch the stock market. You have to do what's right.
The stock market's seen the worst start to 2025 that we have seen in years. We have the S&P 500 down almost 10% and the Nasdaq is down over 12%. And unfortunately, the selling is not slowing down and it could actually get a lot worse. So in today's video, we're going to break down exactly what's going on in the stock market, the 3 key reasons why the stock market is going down right now, the 1 big reason why it could go down even more, and most importantly, how you guys can capitalize on this dip right now. So we're going to break all this down in a no BS way, no clickbait way, just going straight through the facts so you guys really understand what's going on. Here we go. So the first thing we of course have to talk about is tariffs. It seems like every day Trump is threatening tariffs on different countries. So when he threatens the tariffs, the stock market goes down. But maybe those tariffs weren't set to go into effect for maybe 1 month from when he announced it. So the stock market initially falls on the news, but then as the days and weeks go by leading up to that tariff date, the market starts to trend back up. But then when the tariffs actually go into place, the market then falls. And then a couple days after the tariffs go into place and the market falls, Trump says, oh, we made a deal with this country and the tariffs are no longer on the table. So there's a lot of uncertainty right now with tariffs and how this is really going to affect the economy.
We had record-setting inflation under Biden. It was a killer.
You may
it's
get
one
it
of the
again.
reasons I won the election.
But you may get it again with these tariffs, right? I
You
mean,
may get
one
it.
CEO said to me, my input costs have already started to go up. I'm
Well-
going to have to raise prices.
And many investors are fearing that the tariffs are going to make the U.S. economy go into a recession because there's going to be a lot less buying and selling of goods because they're going to be way more expensive because of these tariffs. And of course, this kind of complicates things with interest rates because Jerome Powell at the Federal Reserve, he wants to lower interest rates. But if we have inflation because of tariffs, we're going to keep interest rates higher for longer. So there's a lot of uncertainty around tariffs. And if interest rates actually happen to go up to combat inflation that's going up, the market's not going to like that. The stock market will go down. And you can see that correlation right here very well between these 2 charts right here. So the chart right here with the red line, this is interest rates based on the 10-year Treasury bond. So you can see interest rates went way up in this time period right here, kind of peaking out near 1980. But this right here on the stock market chart right here, the market went all the way from roughly $1,000 all the way down to roughly $500, all because interest rates were going way up. Now you could see interest rates are going up in this time period right here since inflation came back pretty hard. And yes, I get it, inflation is coming down a little bit right now, but if inflation starts to come back, these 10-year Treasury bond yields can go way up, and that's going to put a lot of pressure on the stock market way up here to come down. So this obviously has a lot of investors spooked right now, especially coming off of back-to-back 20% years in the stock market at a time that valuations are a little bit expensive and at a time that interest rates are trending up still. This puts a lot of pressure on stocks to then fall. So this chart right here is basically showing you how much of a premium are you going to get on your money, basically how much more extra return are you going to get on your money if you put your money in the stock market versus in the bond market. So you can see right here in 2013, you were expected to get roughly 10% more per year if you put your money in the stock market versus in the bond market. This was a time period right here where interest rates were very low and stock market valuations were cheap. And then if you draw this line all the way down to current times right now, we're roughly at 3.5%. So what that means is if you put your money in the stock market, you're expecting to get roughly 3.5% more versus what you're going to get in a bond as the years go on. So it's not really too compelling to have to deal with all the risk and uncertainty in the stock market at a time that it's a little bit overvalued, a little bit expensive, interest rates are trending up, and all this tariff stuff is going on right now, and people think maybe we're going to go into recession. So a lot of people are putting their money into bonds right now because they're scared of the stock market, and that's really fueling the fire for this dip to keep going lower. And the other super interesting reason why the stock market actually might be going down on purpose is this chart right here. So this is our current national debt, and you can see right now we're at $36 trillion and climbing rapidly. And the crazy statistic right now is that the US government is paying more interest on their debt than they're spending on all of our defense spending. It's absolutely astronomical. Now just stick with me here for a second. If you wanted to lower how much interest you're paying on your loan, you just go lower your interest rate. Now, I get it that Trump and the Federal Reserve, they're supposed to be 2 separate things, but what if you just purposely put the economy into a recession so that Jerome Powell at the Fed then has to cut interest rates to try to stimulate the economy? You stimulate the economy by lowering interest rates. Guess what? The U.S. national debt is now way more easy to manage because they don't have to pay you these high interest rates on these bonds. Something to really think about. I'm not saying this is happening, but it is possible. And I'm actually really curious what you guys think about that. So comment below and let me know what you think.
We had record-setting inflation under Biden. It was a killer.
You
And
may
it's
get
one
it
of the
again.
reasons I won the election.
But you may get it again with these tariffs, right? I
You
mean,
may get it.
one CEO said to me, my input costs have already started to go up. I'm
Well,
going to have to raise prices.
In the meantime, guess what? Interest rates are down for the last 3-4 days at good levels. I mean, I've been saying, let's get interest rates down. You know, nobody ever gets rich when the interest rates are high because people can't borrow money.
And I'm just being completely honest with you guys. I totally get it. There's a lot of fear out there right now. And honestly, the stock market could go down even more if this stuff starts to escalate. So you can see right here, the S&P 500 officially is down more than 10% from its all-time high, which then puts us into correction territory. So for the last 75 years, we had roughly 60 market corrections. So if we just divide that out 70 by 60, we roughly get a market correction of 10% or more every single year. So maybe the correction that we're having right now is just a normal part of the process, but it also could be all the things that I just talked about that are influencing the stock market going down. Tariffs, interest rates, recessions, market valuations, all this stuff factors into why the stock market is going down. But sometimes the market goes into a bear market where we go down 25% or more. Let's look at the chart. So in the last 75 years, like I said, we had 60 market corrections, but of those 60 market corrections, we had roughly 21 of those market corrections that turned into a bear market where we went down 20% or more. So now this is where things get really interesting and everybody wants to know, if we go into a correction, how long is it going to take for the market to recover out of that dip? So typically for average corrections, it takes roughly 4 to 5 months for the market to recover back to all-time highs. But if we happen to slip into a bear market, you could see it takes way longer for the average market to return back to all-time highs, almost 25 months, so roughly 2 whole years that the market either keeps going lower and then rebounds higher, or it just trades sideways in that lower channel for a while. So there is a very good chance that this is going to turn into a bear market, and in just a second, I'm going to show you exactly how I'm going to capitalize on the market if it goes down more, or if the market happens to rebound and go back up and we get that V-shaped recovery, how to capitalize on this stuff. So now in the event that things get really bad, we could have a complete total stock market crash, which has happened only a couple times in market history, once in 1929 and once in 2008. So if we look at 1929, just to show you how hard the market really crashed, you can see the Dow Jones was up here around $400 per share, and it went all the way down to almost $50 per share. So from $400 per share all the way down to 50, it was roughly a 90% stock market crash. So you can see right here, the stock market had a massive bull run going all the way into 1929, and then bang, just like a pendulum swinging back and forth like a light switch on and off, the stock market just went straight down. This is usually how the stock market goes. There's usually euphoria right here at the top of the stock market, and then that is when the stock market usually just collapses. Now, right here, when there was peak pessimism in the market where people said, no, I'm never going to buy a stock again, that is where you start to build out of the base right there and you go back to all-time highs. I mean, obviously right now the Dow is, tens of thousands of dollars per share, but this was a massive drop in the time. And then you can see this chart right here showing you the 2008 stock market crash where the S&P went from $1,500 per share all the way down to $676 per share. So of course the stock market could go from correction to bear market to market collapse and keep going lower, but it's unlikely to happen in my opinion. So this just goes to show that stock market crashes do actually happen. Maybe we're in one right now. Maybe we should all sell out right now, but I'm going to show you exactly what I'm going to do right now, how to capitalize on what is going to happen or what could happen in the stock market, and how to potentially capitalize on the upside going forward. So here we go. All right, so let's go into the 6 key things that you have to know right now that I'm implementing into my multi-million-dollar portfolio to ensure that if the market goes down, I'm going to be able to capitalize, but also if the market goes up, how I'm going to capitalize too. So the hands down, number one, most important thing that you have to do right now is keep your emotions in check. Keep your pants on. Don't freak out if the market keeps going down or up. There's a lot of volatility out there right now, and people just need to take a breath and chill. Everything is going to be okay if you're a long-term investor and you zoom out. If you have too much leverage right now, you probably are sweating a little bit because maybe the market will continue to go down. Now, if you look at this chart right here of the S&P 500 from 2009 until 2017, you can see the market did a 271% gain in that time period, but look at all the negative things that came out in that time period right there. All these things that happened right here in the moment, they felt like it was the end of the world. But of course, it didn't turn out to be the end of the world. This is America. Things usually go up in the long run, but it's just a roller coaster. It's a bumpy ride on the way up. So it's important not to jump out on the bottom of the roller coaster ride. Now, number 2 is a big one. You don't want to catch a falling knife in the stock market. it is very, very hard to time the bottom of the market. And if you do happen to time the bottom of the market perfectly, you probably just got lucky. So what I personally do is just understand when the market is grossly undervalued or grossly overvalued, and then I make plays to capitalize on that. I don't always try to time the bottom or the top perfectly. I just know that if something is super overvalued, maybe I'll buy put options on the market or I'll just sell my shares straight up. But if something is super undervalued, I might go buy calls, I might sell puts, and I just might buy those shares straight up. So don't try to capture the bottom perfectly. Understand that if you buy into the market right now, it might continue to trend lower as the years go on, but you did get a little bit of a discount from all-time highs. Now, number 3, which is one of the most important quotes that you probably got to know of all time, it's that time in the market is better than timing the market, meaning the more time that you have in the market, the more time you have your money to compound in there. So that's what's going to make you millions of dollars in the long run. But maybe right now you have a smaller portfolio, but in time that portfolio will grow and you're going to be compounding 10% of these bigger numbers every single year as time goes on. Versus timing the market, like I just said, it's very, very hard to time the bottom of the market perfectly. You get in, you get out, and you do all these crazy trades, day trading in and out. That stuff is very hard to do. I'm not saying you won't make money doing that, but there's a reason why 90% of day traders, even more than 90% of them, they lose money, they don't make money in the long run. So understand what the billionaires and millionaires are doing and maybe start doing what they're doing. So number 4 is a big one, and it's honestly just foolproofing your portfolio. You want to DCA in at all times. DCA stands for dollar cost average. So basically, every time you get a paycheck, every 2 weeks, whatever you get paid, put a certain amount of money into the stock market no matter what. Whether the news lines are good or bad, whether the market's going up or down, always do that set amount when the market's going up or down, because in the long run, maybe you bought when the market was a little bit expensive, but maybe you also bought when the market was cheap. So average it out in the long run, you paid a fair price for the stock market, and you don't even have to worry about any of these news articles that are coming out, all this tariff talk, all the recession talk, the interest rate stuff. You don't have to worry about any of that stuff if you just dollar cost average in. Number 5, what do you dollar cost average into? So I recommend most people build the base of their portfolio, which is usually like the S&P 500 and the NASDAQ split 40% in each one, and then usually like 20% in individual companies. This is a way to foolproof your portfolio so that you're not overly exposed to individual companies because maybe those companies go bust. But in order for the NASDAQ and the S&P 500 to go bust, if that goes bust, honestly, we probably have bigger problems to worry about than money at that point right there. And then number 6, which is honestly the whale in the room that makes me so much money, consistent cash flow every single month, thousands of dollars, it's with stock options. But I'm going to be crystal clear right now. Stock options are not for everybody. Honestly, most people shouldn't even do stock options because most people don't understand how to really value the stock market, how to value companies, to be able to spot high margin of safety trades and then use stock options to capitalize on that stuff right there. So you have to understand with a high degree of certainty, which is honestly not that hard to do, if a stock is going to go up and down. So if we're bullish on Apple stock and we think it's going to go up, we could then go buy call options or maybe sell put options to generate monthly cash flow. But if you don't know how to value Apple to know if it's likely to go up in the near term or in the long term too, you can't use stock options to capitalize on that move right there. Options are really just like a leverage way to capitalize on a move that you're expecting to come. So if you don't feel comfortable using stock options or valuing the stock market or really knowing how to find high margin safety trades, watch the video below. I'm going to link it in the video description. It's totally going to change your life, and I'm not going to leave it there forever. I do plan to unlist that video. So check the video out. I'll see you guys in that one.